Hello, everybody. It is time to talk about this man's favorite subject. We're going to talk about tax. Now, Matt, you have the challenge at 6:30 on a Thursday night to make tax easy, light, but educational. For those that don't know, who haven't been to one of our webinars before, my name is James Blair. I am the Wealth Director, Financial Advisor, and co-host of Checks and Balances. This is not my co-host. This is Matthew Harris, Managing Director at Lighthouse Financial Services. He is a taxman and property developer. So welcome very much.
Hey, sorry, you left one thing out, and star guest of the Checks and Balance podcast.
Yes, very much so.
Yeah.
This is all about, Matt, how we, would you say, minimize tax?
Yeah, definitely.
Understand the law?
Definitely. So my background, for those who don't know, I spent a long time working for the Inland Revenue. I came out normal, as you can tell. But
Define normal.
yeah, well, as normal as you could after 9 years at Inland Revenue. One thing I learned there, apart from was everything about tax, was that you're far better off to minimize your tax within the rules and get away with it than you are to evade tax and not get away with it.
Cool. And I am not an accountant, so I'm a financial advisor. So I'm going to be asking Matt lots of questions and keeping the energy light and, fun, because we know an accountant can't do that by themselves. So tonight, we'll probably try and talk for about 30 minutes. The Q&A function is there to use as you go. Ask questions in the chat, give your own tips, your own tax advice. For those that don't know, just quickly about Lighthouse before we jump into talking about tax returns for 2024. So at Lighthouse Financial Services, our mission as a business is to help Kiwis secure their financial future. So we do have accountants, we do have financial advisors, mortgage brokers, insurance advisors. We have a property team here as well. But fundamentally, we believe education plus action and a bit of time and a tidy tax return does equal financial freedom. Matt, why is that so important to us?
Well, I think what this office, and you and I in particular, I think what we believe in is that if you take that action, if you buy those assets and you wait the requisite amount of time, which honestly changes all the time, you will have financial success and you will have financial stability in the future. And I mean, who doesn't want that?
Yeah, and my goodness, there are opportunities out there right now.
Definitely.
So the other piece is like a little bit in terms of a vanity slide. So we've got over 4,000 clients around the country. We are based in Auckland, but we do deal from the tippy top of the country all the way down to, I'm pretty sure we've got a client from Bluff somewhere on the book.
Surely.
We've settled over 900 properties. We've got 100 million plus funds under management. We do a lot of webinars. We've got a podcast, Checks and Balances, that does 3 episodes a week. If you want to educate yourself more, not just on tax returns, but a whole range, Ravi will put in the comments a link to our YouTube channel.
Yep, and I'm not biased. It is a very, very good podcast and well worth watching if you want to learn anything from financial literacy or planning, how it works, to how successful business people in New Zealand have grown their businesses.
Now, one thing though, whether on that podcast or tonight, we do have to do a quick disclaimer. The opportunity to book a one-to-one session off the back of it if you want to talk about your own tax return, what you need to get help with. We're all good with the internet connection, Ravi? Yep, awesome. So yeah, the general terms tonight, chance to book a one-on-one if you need to afterwards.
Yep. Awesome. And just one quick thing, it does say tax returns for property investors, but we're not just talking about that. We're talking about business owners, sole traders, basically anyone who's required to file a tax return.
So Matt, we have a wide range of things we're going to hit on tonight. We're going to be talking about, how you communicate with your accountant. Assume that's important.
Very important.
We're going to talk about maximizing deductions because that means we pay less tax. So that's a good thing.
Even more important.
Yeah. Filing dates so you don't get fined by the IRD. You don't want to get on their bad side.
Yeah, quite important. We might have actually ordered this list in importance.
Yeah. Tax payment dates, which, come back to that, making sure you don't get fined.
Yep.
Tax pooling, which is something that probably a lot of people don't know about.
Yep.
Arrangements where apparently you can pick up the phone and talk to them and work some things out.
Yep.
And future planning. on the tax side. So let's not waste any time, Matt. Let's jump into the show.
Yep. As we say, we're going to try and get through this in 30 minutes so everyone's still awake at the end. Save your questions. We have a big Q&A and we'll get into it. So I wouldn't be a tax geek if I didn't start with a little bit of fundamentals. So just really quickly, New Zealand's tax system is what we call a broad-based low rate system. So it's a really fancy way or tax policy way of saying that we tax everything really widely, but all the rates are really close together. And when you think about it, our tax rate, top tax rate's 39% now, top individual tax rate's 39%, for example. And the only place you get some disparities in company tax rates, but if you get it out back to the 39. So that's kind of premise of it. We have not a very complex system, and probably some people out there are going, are you kidding me? It's actually probably quite complex to people, but as far as tax systems go worldwide, ours is very, very low complexity.
I mean, you think about like people looking on Instagram and TikTok and this guy being like, you need to buy a car over £2,000 and then you can deduct it all and make money from it. Yeah. It's just not that in New Zealand, unfortunately, is it?
No, it isn't, unfortunately, but also quite fortunately because accounting fees and stress at tax time would be a lot higher. If you're in America, you've got a 60-page tax return to go through. So
how do you think the US accent was there? Would you rate it or?
I think I can do a better one.
Off you go.
Yeah. Oh, you have those? Yeah, we've got McDonald's.
Oh, I didn't know what those was. So
well, it could have been anything. Yeah. They might have sounded a bit Bahamian. I'm not sure. Anyway,
they were a little lost about halfway through.
Yeah.
Anyway, so also not many exemptions to go with the low complexity.
Yeah, so not many exemptions. Everything's basically taxed. And so, for example, in some countries, GST doesn't apply to fruit and things like that. We just don't have that kind of stuff. And we have a voluntary compliance-based system, which is probably something people miss because the fear of the omnipresent IRD is always in your life. But the reality is that every single person is required to file a tax return. If you don't, the inland revenue don't necessarily know, but they might catch up with you. And if they do catch up with you, then, there's a bit of trouble coming with it.
Yeah, I think the thing with the tax system as well is people go, because it is quite simple, because it is voluntary, because, a lot of people are on salaries, there's nothing I can do. It just is what it is. But that's what tonight is all about, right? Making sure that you know all those tweaks so you can, make it as efficient as possible.
Yeah, definitely. And there are some things that you can do depending on who you are. If for a minute you're thinking, oh, okay, so if they won't know if I don't file, well, they probably will find out. They have this thing called the compliance triangle, which means that at the bottom you have everyone who's going to comply by free will, and as you go up to the top, to the pointy end, you get people who won't comply and don't want to. And that's how they take their compliance.
Right. You don't want to be at the pointy end.
Definitely don't want to, or unless you're leaving the country, not coming back.
Yep.
Cool. So communicating with your accountant, this is really important. So a lot of people struggle to communicate with their accountant. Often, in my experience, it's because the accountant won't communicate back. I hate that. At Lighthouse, we train all our accountants to answer the phone, to respond. If you want to communicate via text, email, phone call, whatever.
DM.
Yeah,
send us a tweet, whatever suits.
Well, you laugh because I do get the odd Instagram message asking tax questions. So we're happy to take them. So first of all,
DMs are crazy, Matt.
Oh, man. I'm probably already asleep because all the texts I've been reading about. I think, the premise of this is that we can't read our clients' minds. We want you to communicate. So make sure you get in touch with us early, well before any tax filing deadlines, which we'll get to. Don't hesitate to ask if you don't understand stuff. So we get that a lot. People don't understand, but they kind of just don't answer any questions, and they'll come back round and add some more information that would have been important at tax filing time.
Certainly, like if it's the first time you've had an investment property,
yep,
and you're talking about chattels and all these different things, and it's very easy if it's not your world.
Yep,
you don't want to be silly, right? And
exactly.
Don't ask questions.
No, that's right. People feel sometimes uncomfortable like that. We're going to think they're silly. I love it when clients want to unpack it a little bit. Now, don't get me wrong. If clients ring me up and they've started quoting the legislation, here to teach that.
One of my favorites, though.
Yeah, it is. That's care and management of the tax system, in case you were wondering.
Yeah, tell me that. Of course I know that.
Yeah. And so once we've got your return underway, you can expect some back and forth. So make sure that you're ready to respond and respond quickly.
Be ready.
Yep. And also, Shameful plug. Here at Lighthouse, we're a financial services business. We exist to secure Kiwi's financial future. We don't want to just be helping you with your tax returns. It's compliance. It's required, but a bit boring. Some of the stuff we do in here is a bit sexier.
There's a lot more fun.
Yeah. Financial planning, mortgages to buy properties, locating those properties for you. All that stuff helps grow your wealth. Tax returns is about compliance. So what we're trying to do is make it easy for you, get it done quickly.
Yep.
So, maximizing deductions. So people obviously will probably have some questions about this at the end, but really quickly, if we're talking about property investment, a commonly overlooked source of deductions is chattels depreciation. So for anyone who doesn't know, chattels are basically anything that's attached to a house that can be ripped off and the house can still stand. Heat pumps, carpet, curtains, washing machine, if it's part of the rental, all that stuff. So there's a couple of ways you can go about this. The most common is get a chattels depreciation report. It's a bit like a valuer, except that they go on and they only value the chattels in situ. They're actually really good. They give us a full list. We can then put that into our balance sheet, get you a chattels deduction. So do you know what's so good about this, Jimmy?
What is it?
Oh man, it's great. It's the only non-cash deduction that you can get pretty much in property now, or in any tax return. And what I mean by that is that in ordinary course of your tax return, you have income and you have expenses. Usually for the expense line, you would have spent actual money to get a deduction. With chattels depreciation, usually chattels are included in the house when you purchased it. A house is a capital item. You get that deduction for free.
The freebie.
It's a freebie.
Like a freebie.
Yeah, I love a freebie too. So make sure if you've got questions about that and you're one of our clients and you haven't done it, get in touch.
How much does somebody save, like on average, if you have like an $800,000 million house? What's like a normal sort of number you might save?
You can expect a chattels valuation is going to cost you somewhere in the $600 to $800 mark, and you can expect deductions in tax of $6,000 over time.
Wow.
Yeah. So huge rate of return on that
Ravi's
one.
impressed.
Yeah, it's a big one. Right, vehicle expenses. This is one that is quite complicated depending on who you are, but I'll just brush over it quickly, right? So you either, if you have a company, it gets quite complicated. You have what's called fringe benefit tax, which we're not here to discuss tonight, but you can use the motor vehicle rules, which are effectively done on logbook or kilometers, dollars/cents per kilometers. It's just gone to $1.04 per kilometer, or actual use, which is quite hard because you have to substantiate it. The example I usually use, right? You own an investment property in Remuera. You live, you live quite close, don't you? No, Ricky. But
let's say I live in Henderson.
Let's say you live in Hamilton.
Oh,
what's it?
Better.
100 k's to Hamilton, maybe.
Yeah.
Yep. So you travel to your rental 5 times a year. It's 100k each way. You can claim a mileage deduction for that 1,000 kilometers. That's going to be $1,000 deduction. So
what about if you have what if, say, I've got investment property in Wellington?
Yep.
Can I claim the flight to go and inspect the property?
Yes, you can. But you've got to be careful with that one. If you're going to do other stuff as well, then there's likely an apportionment.
Nah, I'm just a businessman doing business things.
Yeah, of course, doing property tours.
Yes.
So that is a good way to get a deduction. Again, it's something where you might have spent that money anyway. So, for example, if you went from Hamilton to Auckland and you were going to maybe do some shopping afterwards, you're going to get a free deduction.
Yeah.
Claim home office expenses. This one's a great one. Your business. Now, this one's a great one because the Inland Revenue took a test case on this called Banks versus Commissioner of Inland Revenue. He was a school teacher. He used to mark his little reports at his kitchen table. He wanted to take a deduction, and Inland Revenue challenged it.
Let's pause for a second. Can people just let us know whether they can hear us or not?
I blame Ravi.
Yeah, Ravi's just not great on the tech behind us.
Easy to blame.
It's cutting out. On and off. Any suggestions, Ravi, on what we do?
Even the podcast is bored at text chat.
Bloody Ravi.
Bloody hell.
Yeah. Yes, it's cutting out, cuts out. Oh, okay. Cool. Okay, so Ravi is listening to the audio that everybody else is getting. So he'll put his hand up if it's not as good. So anything else to add on home office expenses?
Other than the Inland Revenue has basically approved it. They lost the test case, so you can claim it. So it's a great one. If you're not already getting that, make sure you speak to us or someone else. Oh, you missed the home office at the beginning?
Yeah.
Yes, I can. Okay, I'll go over it again quickly. So
What's better than once on home office?
Oh, man.
Twice.
Never in my wildest dreams did I think I'd have to go over it twice.
Yeah.
So home office expenses, this is a common claim that we will try to get our clients. At Lighthouse, we work on a 10% deduction. So that's a 10% claim of the total cost of running your household. So that's rent and or mortgage, interest only, not principal, rates, insurance, telephone, internet, more or less. What we do is we add all that up. Good question from Sophie. We'll cover that at the end. We add all that up and we take a notional deduction for it. And it's a good one. The Inland Revenue has done a test case on this. They lost. We can have it.
So if I can do an example on that one. So
Yep.
say I've got a $1 million mortgage.
Yep.
And so I've got a 6% interest rate. I'm $60,000 a year. I'm paying interest. Then I've got some rates and, like you said, all those other bits. Let's round to $70,000
Yep.
a year, right? So you're saying 10% of the house, so that's $7,000.
That's correct. That's a $7,000 deduction in your tax return. So
And-
take it from net income.
Yeah. So if I've got like $100,000 profit, which would be a big property portfolio, and I'm taking off $7,000, then my profits drop to $93,000. So I probably save myself $2,000
$2 to $3,000. Yeah.
a year in tax.
So you can see it's significant. If you put the chattels deduction on, then you put your mileage on, then you put your home office expenses on, suddenly we're in the very legal minimizing your tax realm, and you're saving thousands of dollars.
I think another really important piece is touch on here, right, is as interest rates start to come back down, profitability for property portfolios is going to start to go back up, right?
Correct.
And the other piece is the interest deductibility rules have all come back in.
That's right.
All of these things, everybody's been losing a lot of money for a few years. So all of these things probably people haven't cared about as much, right? Because I'm in the negatives, but now they become quite important.
Yeah, I think that's actually a really good point because people tend to make a loss and not think too much of it. In the old days, prior to ring fencing, we used to have this intoxication outcome, which is the euphoria you feel when you get a tax refund until you realize it was your own money to begin with. And so we used to get people who would get a $5,000 refund and then the next year when they made a profit complain that they had $1,000 to pay. And so I used to have to explain to them that when you have a refund, you've actually lost that money completely. When you pay tax, the max tax you can pay is now 39%. Back then it was 33%. So all the rest of it is free.
Yeah.
So anyway, you're dead right, though. We're about interest rates on the track back down. These deductions are going to become important again.
Another OCR announcement on Wednesday. I'm just seeing some comments coming in the chat. If we can try our best to put them in the Q&A just so we don't miss them, because we're going to answer all the questions at the end.
Yeah, I definitely, those are good questions for those people. Right, use the right business structure. I'm not going to labor this right now, but because we're going to cover it at the end, but having the right structure, especially if you're multi-income and in terms of people and or businesses investments, will make a big difference.
And that last one, Matt, keep impeccable records.
Yeah, so I have a great analogy for this one, right? So imagine you run the local pub, maybe in the country somewhere.
Everyone's thought of owning a pub before.
Yeah, definitely they have until they realize that maybe it's not the best idea for lots of reasons. So you run the local pub, but you take cash over the counter a lot. It's, everyone knows you, no problem. Right, you get a bit older, you decide you want to retire and sell the pub. You go to engage a business broker to sell that pub for you and he asks for your records. Your pub makes no money. You cannot sell a business, convince a bank to give you money for a property, buy any other type of asset or go forward in any financial way at all unless you have good records.
My pub will be rich in memories.
Yeah, oh man, the people who went there loved it. This is really, really important. The better records you keep, the better deductions we can get you. If you ever get audited, God forbid, the easier we can get rid of the Inland Revenue. If you want to get a mortgage for lending, for buying a property, buying investments, buying a boat, buying a car, whatever, good records. You want to pay the least tax possible under the law, good records.
Yeah. The other bit is just like some small things, right? Like having separate bank accounts.
Yep.
I've seen messy scenarios where money's going in, money's going out. It's a mess. Making sure everything is kept separate will be much easier to track. Like the managing, the vehicle expense side.
Yeah.
You need to be knowing what's going on there, taking pictures of receipts and all those kind of
things. You
things.
don't have to go overboard, but bigger receipts. And the other thing that will happen is you save yourself some accounting fees, because if it's easier for the accountant to deal with, you're going to be far, far better off.
Awesome. Okay, so tell us about the filing dates.
Yeah, so this one's a bit boring, but probably misunderstood. So I'll just go through it quickly. New Zealand has a 31 March balance date. If you're in Australia, it's 30 June, because I see some Australians on here. Don't be mistaken. Here it's 31 March. You can have non-standard balance dates in New Zealand, but it isn't common, and you have to apply for them.
G'day, mate.
Yeah, hello, all my Aussie mates.
We're
both Australian.
We're both Australian.
We should stop hating ourselves, yeah.
Crikey, it's a tax return. Sorry.
Another snag on the barbecue.
Yeah, off we go.
Okay. So 31 March.
They're like, can the audio cut back out?
Basically, we're over. So 31 March is balance date. If you have no tax agent, so that's an accountant, you have to file a tax return by 7 July. So not a big window. If you have a tax accountant or tax agent, you have until 31 March the next year. So that's on websites with extension of time versus no extension of time. And I'll forgive anyone who didn't know that acronym. That means that when you have an accountant, not only are you going to get all your deductions, pay the least tax possible, get to speak with our mortgage brokers, our financial advisors, and everyone else, you also get longer to deal with it. So there's less stress.
More time to sort your tax. Is a tax agent like the Netflix show Night Agent? You watch that?
I haven't.
Oh, great show. I'm sure very similar. He's out there saving the president, all kinds of things.
Well, I mean, they did a biography, a docu series, or I think it was a movie actually about accountants. I think they called it The Accountant. Starred Ben Affleck. That's actually what accounting's like.
Yeah. He was like a hitman.
He was a hitman at night, and then he did the returns during the day. That's how we live.
Yeah. And what he also was, and Ben Affleck as a human being, organized.
Yes, he was. Yeah. So great segue.
It was.
Even though you've got a extension of time, we do not wait until the next year, a whole year later, to file it. And there's lots of reasons for that, right? If you're a provisional taxpayer, which we'll cover shortly, the dates come sooner than 31 March the next year. You get off your mind easier. If you get a refund, you get that back quicker and in your pocket. And imagine that you're working with us to buy properties and build your wealth over time. You're going to want to get some lending probably. The bank's going to want to see those returns. So the sooner you do it, the better off you're going to be. And that's just fact.
Yeah, you file a tax return early, you got 99 problems that tax ain't one.
Oh, man. This has descended. Okay, so tax payment dates. So if you are not a provisional taxpayer, you will have to pay your tax on 7. What is the tax date? 7 April the next year. That's what we call the terminal tax date. If you have a tax agent, you pay on the same day. But where it gets confusing is if you're a provisional taxpayer. So really quickly, because you'll need to speak to your accountant about this, and you'll know if you are one, provisional taxpayers have to pay tax in installments in advance. So if you're under $5,000 residual income tax, which is basically if you file a tax return, your tax bill was under $5,000, you don't have to do anything. You just pay at your terminal tax date. If you're over $5,000, you have to pay an installment. So they're there on the screen, 28 August, 15 Jan, 7 May. Those are the dates. So imagine you're a 31 March balance date, and we're saying you get a whole year later, 31 March to file. Obviously, if we don't file till, let's call it November, you've missed your first provisional tax date. So if you're a provisional taxpayer, we want to do it quicker.
Yep. Okay. And if I go, am I or am I not a provisional taxpayer? Your point is, you'll know.
Yeah. And if you don't know, you're in trouble. And the reason being is there's 2 reasons. So first of all, this catches first-time taxpayers out a lot. So imagine James leaves the bank and he wants to go into business. He decides to set up as a financial advisor with a really well-named and reputable firm in the city. He goes into business and he has a great year. And he makes $200,000 profit. He would have a pretty big tax bill, probably around the 60 to 70 grand mark. he
I've
hasn't
got a home office though.
yeah, well, we'll reduce it by, and you travel, to see some rentals every now and then.
Yeah, I actually live in Hamilton.
Yeah. You can have a pretty big tax bill. And because you're in your first year, you've not paid provisional tax, because obviously that provisional tax trigger doesn't happen until you file your first tax return. So that is a big thing to look out for. If you're in your first year of business, you haven't filed your first tax return, and you haven't put some money aside, then you need to be careful about that. And the reason being is that you're going to have your terminal tax due on 7 April, and then you're going to have your very first provisional tax due, which is going to be a third of the tax for the total for the year due on that 7 May, that first provisional tax date. And what that means is that you're going to find a shit ton of cash.
Yeah. And if you stuff this up, you're not the first and you won't be the last. But the implication is you're going to be focusing on paying tax opposed to focusing on your business and growing it. So it's really important, structured tidiness, understanding your obligations so you can focus on the right things and not get distracted by these things.
Yeah, definitely. And just a bit of a plug to help accountants out everywhere, whether you work with us or other accountants. Accountants won't always know how good or how well your business is going in that first year. If you haven't been speaking to them regularly, they will have no idea that you potentially have a property tax issue. Reach out. Send them your zero printout. Say, hey, this is what I'm sitting on. Do you think I'm going to need to do something here? So the only final thing on this is that you can make voluntary payments in that first year, and Inland Revenue does give you a tax discount.
Awesome.
First and last time you get one.
And how good are those?
Yeah. Cool. So I've just gone through Prov Tax. What I will quickly touch, though, is that you can estimate it up or down. We need to do this very carefully. If you overestimate it, Inland Revenue does not care. If you underestimate it, they'll come for your firstborn. That simple.
Yeah.
They'll charge you.
There's a bunch of kids at the bottom of the ID building in Wellington.
Yeah, and they're smart enough. If you underestimate it on purpose to give you one of their bad kids, they don't take them. Yeah. So this is where tax pooling becomes really efficient. So this is like magic.
Yeah.
This stuff is amazing. So a bit of history on tax pooling just to try and make this whole thing a bit more interesting. We're trying. It was invented by a man named Ian Cooperis, and he used to work for Inland Revenue. I think he was in the policy division, but I'm not 100% sure on that. And he realised that people were paying. So in New Zealand, if you underpay your tax, you pay use of money interest. Current rates are 10.4% for underpayment. If you overpay, it's 4.3%. So huge arbitrage from the Inland Revenue.
It's like a bank.
And use of money interest is just that. What they're saying is you have the use of that money instead of giving it to the government, so you got to pay for it.
Yeah.
So it's a really high rate. What he realised is that there were a heap of taxpayers in New Zealand who had credits, so getting 4.3%, and a heap of people who had underpaid or had tax bills, and they were getting charged 10.4%. Inland Revenue every year adjusts those rates depending on how the market is. But in short, if you underpay, you get stung. If you overpay, they give you a little bit.
Yeah.
He realised that if those people could access each other's tax credits, then he would have a system where people could minimise their tax. So he lobbied the government, and guess what? They changed the rules. Tax pooling was born. So this is magic, right? So James has had a great year in his business, and he underpays his tax. Or he doesn't have the money put aside. We can go to tax pooling and we can borrow that money from them. It does two things. You get a lesser rate than 10.4%. You get maybe call it 7%, but you don't get any late payment penalties. So late payment penalties are the silent killer in underpaying tax. The day after that you miss your tax payment, you get 1%. The 7 days after, 4%. And then incrementally 1% every month on until you pay. And it climbs rapidly.
Yeah.
So tax pooling will allow you to buy that credit at the original due date. You'll pay a spread to the tax pooling intermediary, who are basically a finance company.
Yeah.
But you'll get no late payment penalties.
Yeah.
And you get to manage your affairs without having Inland Revenue manage them for you.
Yeah, I know. For the wealth business, I just have an automatic payment set up every week.
Yeah.
Where I don't have to worry about setting money aside. It's essentially like an expense. It goes out, it builds, making a little bit of interest, and then there's all this money set aside based off what I forecasted. I think my tax bill will be.
Exactly. So that's the final bit on it. If you are not behind the eight ball, and you want to get ahead of the curve, you can actually set up a tax pooling account and you can deposit into it weekly, monthly, fortnightly. It sits in that account, it earns you interest, but it keeps the date, effective date when you paid it. So if you ever have to give it to Inland Revenue, the date you paid it to the tax pool is the date Inland Revenue will recognise it.
Right.
So it's a great system.
Yeah. I know I had an example of this a few months ago where I got hit by a bigger GST bill than I thought.
Yep.
And I was like, ooh, this hurts. And my accountant at Lighthouse goes, well, if you don't want to take that out of your cash flow, you've actually got all this money set aside, probably a little bit too much with tax pooling. Why don't you take a little bit of that and throw it across?
And that's meant to work. And the other final thing about it, which I hope no one has to do, but if you make a voluntary disclosure, so that's when you've picked up something incorrect in your tax return, and you go to the Inland Revenue to correct it.
You don't actually live in Hamilton.
Yeah, I've overclaimed my vehicle expenses. You can go and use tax pooling to pay that tax then. Why is that significant? So imagine you pick up this error and it's 3 years ago. They will reassess it for 3 years ago. Late payment penalties at 141 will go on. Use of money interest at 10% will go on. 3 years of compounding. We all know compounding returns the most powerful force in the financial universe. Well, they work.
Super villain.
Yeah, super villain. It's for every good thing, there has to be a bad thing. So I know it's quite hard to explain, but in short, there are ways that you can manage your own tax payments and the cost of it via tax pooling without going to Inland Revenue, which is our next slide.
Let's move on.
Cool. So tax pooling would nearly always be our first cab off the rank. But if you don't have the money in any way at all, because obviously to tax pool, you need some money, we can go to Inland Revenue and we can ask them to put in an arrangement. So to keep it simple, Inland Revenue will pretty much accept any arrangement as long as it's paid off within 2 years. So just divide the tax bill by two years, 24 months or weeks or whatever you want to pay it by, and that's how much you can put in an arrangement without too much hassle. If it's more than that, we can go negotiate the circumstances. Remembering though that when you're in arrangement, you have to pay arrangement and keep up with your current taxes, so it can be a bit of a cash flow drag.
Yeah.
If this is really a problem, so this might have been something that happened during COVID, for example. We had a lot of hospitality businesses that couldn't operate. They would have been a bit of financial pressure. You can get relief from tax, which ranges from a full write-off to a partial write-off to removal penalties and everywhere in between. I think it's important just to know that you can negotiate within the revenue. A lot of people assume it's just done and done. That is not how it works. You can negotiate. The most unlikely place to find a negotiating partner.
Yeah, I actually had this happen to me with a client just the other day where they had to pay a $37,000 tax bill for Brightline, and all of the cash she had in her account was $37,000.
Yep.
So she didn't want to pay it all because she had no emergency fund.
Yes.
So she paid $20,000 and then worked out a plan off the back of it, so she could keep a bit of cash if something goes wrong.
Yeah, exactly. And I'd like to think that if she was our accountant, we would have our client. We would have also tried to negotiate a slight write-off for that, because a lump sum is a commitment from you to It's the internet.
Okay.
Sorry, guys. Yeah, we know, Mark. Thank you.
Yep. Okay. Everybody should be able to hear us again now. Sorry.
Connie, yep, you're right. Lump sum is a commitment. So that's a commitment to getting your tax affairs in order. So remember the compliance triangle?
Yeah.
At the bottom of the people who know how to comply, willing to comply. At the top of the people who won't comply, know how to and won't.
Yeah.
In between is everyone else between, but Inland Revenue loves the people who know how to comply and want to comply.
Yeah.
And Section 6A of the Tax Administration Act, which I quoted earlier, I purposely use that section is because that is basically what they call care and management of the tax system. The Commissioner of Inland Revenue is charged with collecting the highest possible tax take over time. What that means is they can negotiate. If you're going to give them a lump sum versus them having to try and collect it from you, which costs resources, time, and is unknown, they will generally negotiate as long as you haven't been taking your tax money elsewhere and buying super yachts or whatever.
Yeah. Lump sum is a commitment, and then the internet going out is like a cliffhanger on your favorite TV show and they're going.
And you got to wait a whole year for the next season. Yeah, I hate that. Cool. So tax pooling, obviously, we've talked about that. That can help you if you've got some money. And then the really important part here, because remember, this whole thing is designed to give you the information, not to do it yourself, but to know the questions to ask your accountant, to lean on your professional advisors and understand, the system. The sooner you get onto inland revenue. So, for example, your GST returns due, you know that you're going to be short 10,000 or 20,000, but you know that in 2 months or 3 months, you're going to have a big sale go through. Get on to us early. We'll go and we'll put that arrangement the day after it's due. All those late payment penalties be frozen, and you won't get the extra cost. But if you leave it a week, 2 weeks, you've got the 1% and the 4% straight away, and potentially inland revenue unhappy.
Just like everything in life, just good to fess up early.
Yeah, it is, and don't stick your head in the sand. Yeah, cool. So future planning. I think this is the final slide. This one's really important. A lot of people that come into this business as clients don't have the correct structure for a number of reasons, and sometimes structures just their circumstances have changed over time, and the structure that they had is not right, or other times they just have never taken any advice on it. So when you have these different types of structures in New Zealand, sole trader, partnership, company, trust, and look-through company, they all come with different levels of asset protection, which we think is really important here, different levels of tax rates and flexibility. So to give a really easy example, so imagine you have a investment property portfolio that has 4 properties in it, and you are making $20,000 net a year in that trust. And there's 2 people involved in the ownership structure. Let's call it a husband and wife. The wife is a big-time lawyer, for example, $250,000 a year, so getting smacked at 39% for everything over 180.
Go get it.
Yep, go get it. And dad's at home bringing the kids up and giving them the childhood of a lifetime, and he earns no money. So he has a tax.
But earns money in other ways.
Yeah, well, he just does all the work at home. Yeah, basically, guy's more stressed than the lawyer, probably. So he's got no taxable income because he's busy raising the kids and keeping everything in order. His tax rate starts at 10.5%. So that 20 grand in the hands of the high-flying lawyer is going to be taxed at 39 cents in the dollar. So call it 8 or 9 grand. The stay-at-home partner is going to be taxed at 10.5%. So do the maths for me. 20 grand.
2 grand.
$2 grand.
Yeah,
it's $2 grand. Huge difference.
$6,000.
$6,000 difference, and the only thing they've done differently from any other person is had the correct structure in place. So trust is just one example, but we see this commonly. Having the right mix of asset structures and people involved in them will allow you to allocate income effectively. So a question I get asked all the time after these people watch these damn YouTube videos is profit splitting. You cannot profit split, right? If you're a husband and wife and you both PAY earners, you can't sacrifice some of your salary to them to pay less tax. But what you can have is an effective structure for your assets or your business income that allows that. The other one is obviously consult a professional. A lot of people go along and they just assume, for example, we get in the mortgage space a lot. People just assume they can't buy a property, can't assume they can't get a mortgage. Then they go and talk to one of our brokers and they get an approval and they go buy a house.
Yeah.
Limiting beliefs are one of those things that everyone has. And tax is definitely an area where, why wouldn't you not know anything about it?
Yeah. And I talk to some really smart people where, like, say, for example, the trust component with the high earner, no earner, and they're doing no income splitting, and you're just like, this is costing you quite a bit of cash.
Yeah, definitely, and the eyes light up when there's these simple things, and the same with debt restructures, which is something that's become possible again since interest deductibilities come back in. We get a lot of people who have no debt on their investment property and hundreds of thousands, if not millions, on their own homes. It's literally the most tax effective thing there is.
Yeah. So on the debt loading side, which I think we did a webinar about not that long ago,
we did.
I had a client which the accounting team worked with just the other day, and they had a $1 million mortgage on their own home and an investment property that was worth north of $1 million with no debt. And so that is effectively costing them, say, at a 6% interest rate, $1 million, $60,000, $20,000 a year in extra tax. And just by talking about, how can we restructure this? Huge tax savings. And then you've got a debt-free home in this scenario, which means you've got cash flow, right? You don't have those mortgage repayments. They're tied to the investment property.
Yep.
You can go buy another property. You can invest into shares. You can invest into business. You can go do all these things.
100%. And the theme of this webinar is minimize your tax within the rules. And do you want to do the quote or will I?
Kerry Packer's quote.
Yeah, go on.
Yeah, Kerry Packer, very famous Australian businessman owning Channel 9, got sent to court and was like, you're trying to minimize your tax, not in the spirit of the law. And I'll let you finish the...
Yeah, basically, his answer is brilliant. He said that anyone who's not minimizing first of all, he said, I don't know anyone who's not minimizing their tax. Good call. He said anyone who is not minimizing their tax needs their head read, because as a government, they're not spending it so well that you want to donate extra.
Yeah. The last bit, we'll leave that up to you, but certainly you'd prefer to have money in your pocket.
Yeah.
Okay.
So I don't care how rich you are. Yeah, $1,000 and any amount of money that is paid over and above what you are legally required to in the tax system is better off in your pocket for all those reasons you said.
Yeah, for sure. So we're just about to jump into the Q&A. We've got a bunch of questions there already, which is awesome. Make sure to keep putting them in there. But for those who go, well, it's the 13th of February. I don't like my accountant. I don't have an accountant.
I haven't heard from my accountant.
Yeah. Or geez, there's some things I'm not doing that I should be looking into.
Yep.
What can we help with, Matt?
Yeah, so everything in the accounting sphere is the answer, but we do a lot of property investor returns. We do a lot of business accounting, small business and medium business. We do trust and structuring, so companies look through companies, restructuring. We can help with provisional tax pooling, getting under arrangement if you're in a bit of trouble. If you're an Australian, we can help you with SMSFs and investing in New Zealand, which is it's a good plug from you, Ravi. And we are property specialists, and we don't just do the work. Everyone in here nearly owns a property. Lots of us own multiple properties. James owns 12 just on one goddamn title. Well, it's not one title, one property.
I bought another 12 today.
Yeah, so there you go. So we get out there and we walk the talk. We know the struggles that you have gone through with high interest rates. We know what it's like to have repair bills that came out of nowhere, and we know what it's like to have to deal with the compliance. So we're here to help.
Awesome. Okay, so we are moving on to the podcast. The podcast.
Go back, Ravi.
Podcast. So just quick plug
the podcast.
Interesting. We've got the girls on there instead of just the boys. So we've got checks and balances, which actually, one of the episodes this week does go through tax tips. So Ravi might put that one in for those that maybe missed some of the presentation. But if you want not just to sort your tax, but you want to make sure you're taking control of your financial future, make sure to check out the links, check out the podcast. It is there to help you.
Yep.
But let's get into the Q&A, Matt. I will ask the questions. You shall answer the questions. So Penny has gone with chattels. Do you have to wind back the depreciation on sale? How does that work with a heat pump, for example?
Penny, that's an excellent question. And so people who have been investors for a while now will remember the days when you had depreciation on properties. So it was 3% from memory, and you used to get a big non-cash reduction. And this was prior to ring fencing, so you got actual refunds as well. That's long gone. Depreciation was removed on buildings, and for the accounting geeks out there, the reason being is that depreciation is allowance for something that's expected to decline in value, and properties do not decline in value over time. Obviously, they go like this, but give me a 10-year window and show me one property that's gone down and overall, unless it's burnt down.
Well, the land goes up in value, but the value of the actual property.
Yeah, but it doesn't, when you get your valuations, they still assign quite a large amount to the property. But that's the general premise on it. So that used to have to be recovered on sale, depreciation recovery. One of the reasons that we have a 0% rate on property now is because people didn't recover their depreciation. So the answer to the question is that we would expect as long as you don't get the valuation and then sell the property immediately, which would mean you had no deduction anyway, we don't recover. And the reason being is that we think that at the time that you sell, we would value those chattels at near nothing because they're wrapped into the capital value of the property. So the answer is no, you do not.
Awesome. Another one from Penny. It was my understanding home office was claimable only as a percentage of the area that your office was versus the total square meters. So say if your 20 meters is your office of 100 square meters, that'd be 20%.
Yep.
Is 10% a common blanket claim?
10% is a common blanket claim, and you're not wrong that generally we're trying to approximate the office space versus the property space, but home offices are nearly a thing of the past. Like I've got one, I think you've got one, but we're businessmen.
Doing business things.
Business things. The reality is that most people don't have a dedicated office in their home, and what we're trying to, and also homes vary in size. Some people use the whole garage. Some people just need to store stuff in one room. We try to approximate it, make it easy for clients. With all this stuff, we would try and make sure that it's as accurate as possible. I think someone put in the chat, if you have a property manager, can you claim? If your only investments are properties, the answer is no, because why would you be using your home office? Yeah.
Cool. Okay. Does the home office expense claim apply if your rental property is overseas?
Yes, it does. And the reason being, if your rental property is overseas, you're a New Zealand tax resident, you're subject to tax on worldwide income. You have to return that income in New Zealand.
There you go. Next one. If I have two businesses, may I claim home office expenses 10% for each?
No,
10% together.
It's 10% together. And you would, if you had a good accountant or us, we would pick it, we would put it where it was the most use. So whichever business had the most profitability.
Cool. Did you just answer this one? Can you claim the home
Yeah,
office?
I did, Delia. So generally, no. It's not a blanket no.
Sorry, because I'll just quickly read out. Can you claim the home office expenses if you have a property manager?
Yeah. So it's generally no, but it's not a blanket no. And the reason being is you can have a property manager but still be quite active in your property management. But if you're completely passive, the property manager does everything, just sends you the check, then you can't. But if it's a mix, and for example, we have clients who might have 5 properties under management and they manage 5 themselves, well, of course you can claim it. Just because you've got a property manager in that scenario doesn't mean you can't.
Cool. Next one. If I was a sole trader one year making 300,000 and then went very part-time the next year, how do I get out of provisional tax payments?
Yeah, well, so you would, if that was true and you were comfortable with that, we would re-estimate your provisional tax payments for the next year 0.
Cool. Okay. Can you claim the vehicle expenses if you have a property manager?
I think it would be pretty dubious. Remember, with all this stuff, right? Anything that you do, we have a voluntary compliance system, which means it's not automatically going to get checked, but we work on the general premise that anything that you do can be scrutinized. So you better be ready to have the receipts, the story, the narrative like that. What's the narrative when only revenue goes, you claimed $1,000 of travel and you've never visited your property because you've got a manager. So it's about being sensible. So I'd say probably not.
It's just like when you go, the cops come, right? You got to have your story straight. Is there a time limit for how long a deferred tax asset lasts in the eyes of the IRD, i.e. losses accumulating from year to year from a recent rental property purchase? Is it limited to 7 years, 10 years, 20 years, never before the tax losses expire, i.e. to use in the future when rentals are profitable? Thank you.
Thank you for that question. So first of all, I'm impressed because not once in this webinar did I mention deferred tax assets.
Oh boy.
So deferred tax asset is exactly what it sounds like. It's a tax credit. We also call them IRD approved losses. The short answer to that one is that you can carry them forward indefinitely. The rules changed a few years ago back now. So if you have expired your portfolio in totality, I believe that you lose them. But other than that, you can carry, and I'm not 100% sure of it. It's been a while since I looked at that rule. But the short answer is you can carry your losses forward forever. If you own a business, for example, nothing to do with property, and you make $100,000 loss, and then you go, oh shit, I'm no good at this one, and you stop the business, but you keep your company active. As long as you file your company's office returns and file your tax returns, carrying that loss forward, you have it forever.
Nice. Okay. What are your accountant fees for property investors with 2 properties in an LTC?
Oh, you put me on the spot. I believe 2 properties in LTC, including financial statements, income tax returns for the LTC, the individuals, provisional tax management, and basically dealing with you would be $1,900 plus GST.
Cool. Do you charge a blanket tax return fee, or is it based on hours required to sort them?
In general, fixed fee. So it's based firstly on the structure. So for example, in that example, a LTC return is $1,600 plus GST for one property, and then every property after that's $300. So that's how I worked that out in my head so quickly.
It wasn't that quick.
It was quite quick.
I got a little bit bored as I was waiting for you. If you live in the UK, can you still claim the 10%?
No, well, you're a tax resident of the UK. I think theoretically, yes, because you are so tax residents are subject to tax on New Zealand sourced income and worldwide income. Non-residents, so you'd be a non-tax resident, I assume in the UK of New Zealand, you are subject to tax on New Zealand sourced income. So theoretically, you should be able to claim a credit. Whether we do it or not, we might have a conversation first.
Cool. What a really busy offices out there.
Yeah.
Can you talk about GST registration income limits and what all counts towards the 60K gross? After covering what all needs to be included, can you specifically comment on the host remittance tax that Airbnb reimburses? Does that count to 60K limit? Exceptional question, Anonymous.
Hopefully the same person, just getting all their tax questions out of the way. I didn't mention GST or Airbnb either. I was trying to keep this thing not complicated. So GST is a consumption tax. It is not levied on residential property that is used for the long term. And the reason being is that the government does not want rents to increase as a result of that. It's one of the very few exemptions in our tax system, but it does apply to short-term accommodation, hotels, motels, farm stay, boarding house, or similar. Airbnb is the similar one. The 60K is gross income. So a lot of people think that it's the net result that is GST registration threshold. It is 60K. It is the gross. Where it gets people commonly, the issue I see is that if you imagine you're a sole trader and you earn $40,000 or call it $50,000 mowing lawns, you're not GST registered. Then you have an Airbnb that earns $30,000 together in a sole trader environment. Together, you have to be registered. So that's something that I see a bit. The remittance part, this one's subject to a bit of debate, especially since the very stupid GST allocation rules came in regarding short-term accommodation. It is my opinion that it is the nightly rate plus the cleaning fee that counts towards the gross. So it's not the remitted amount. But I think that's subject to discussion.
You had to ask about the 60K GST limit.
Yeah, you had to, because you've just made this 10 minutes longer. The other thing about GST and residential properties are, there are lots of considerations to be made if you're bringing yourself in and out of the GST net in regards to change of use adjustments, downstream liabilities on GST. I could go on.
Ravi, wake up, Ravi.
Oh, shit. I think the tax talk actually killed him. Yeah. If you're our client, email me. If you're not our client, email me. I'm happy to take this discussion offline.
Cool. Please do. Penny is back in the comments. Would you say that the extra compliance cost of trust is worth the tax saving? This is an excellent question, Penny.
It is. Yep. So in this office, we would only ever do some restructuring if we could see tangible outcomes. So often the juice is not worth the squeeze, and we wouldn't do it. So there has to be, to have a trust structure, especially, there has to be an overriding asset protection element, family, business, and I want to see some sort of ability to save some tax. So that example where there's two people and one has higher earnings, one has lower earnings. So sometimes it's not, Penny. Book in for a call. We can chat about it.
Cool. Can't you get a big old discount, pay your tax?
Yeah, so yes, you can. Do you think I remember the discount right now? No. I'll probably Google it. Ravi can Google it and put it in the chat.
Ravi doesn't even know what to Google.
Yeah, Google. Yeah, voluntary tax payments first year, IRD, will probably get it. It's not much, but it's something, and as I say, it's the first and only time you'll get it.
Yeah. Cool. Okay, while Ravi's looking for that, he'll put it in the chat.
Buy a house right now. That sounds like financial advice. You want to lose your life? Go on.
If I fly to a different city to visit a property, the flights can be claimed. What about meals, car rentals, accommodation? What happens if kids have to come along? Because you don't want to leave the kids behind, unless you do want to leave the kids behind because you want to have a boys' trip.
Yeah, well, as we say, the only revenue will take them if you miss your tax. Yeah. So. Look, that's a complicated question. I'm going to give a complicated answer. Yeah. The long story short is all this stuff, right? The more sensible you're about it, the less chance of getting in trouble and the more chance of keeping that tax relief that you got. People say to me, so they go over conferences right overseas and they want to claim 100% of it, but they took their partner, they went for a 2-day conference and they had 4 days in the city afterwards. I would apportion that 2 over the 6, sorry. That's the sensible approach. With this example, we'd be, trying to claim enough of it that is sensible, that relates to you going there and inspecting the property, and not so much of it that you get in trouble for taking your wife, kids, or mistress or otherwise.
Nice. Okay. And that's deductible as well, by the way.
Yep.
Should I buy a house right now? Well, that's got nothing to do with tax. Maybe buy 2. If
that's not financial advice. Look, nothing wrong with us giving a bit of commentary. Everyone will be aware that the New Zealand property market has been well depressed for a couple of years down. Nationwide down about 20%, which on the background of how far we came up, it isn't that bad, but there's a lot of green leaves in the economy at the moment, especially in the property market. We've had 3 rate cuts, at least another 1 expected, if not 2. We definitely have a supply issue brewing again, where not enough houses have been built over the last 2 years. And the reality is, if you buy a house today, and in 10 years, I ask you how well you did out of it, you're going to say very well. The cheapest time to buy a house was yesterday, and the second cheapest time is to buy today. But make sure that you talk to someone in this office and have a plan.
Nice. Let's go back to chattels. Is it worth getting a valuation done on an old property where chattels are old? And I am talking super old.
Okay. Yeah, look, it depends. Inland Revenue doesn't like chattels valuations on properties that have been owned for a long time. And the reason being is pretty obvious. The chattels are super old. It comes down to that common sense thing. If Inland Revenue asks about the deductions, are you going to be able to stand there hand on heart and give an answer that was based in some sort of reality?
Could swing back though, right? Like it could become vintage.
Yeah.
And we could get some appreciation.
We could. The better answer is, or better question is, what happens if I buy a heat pump or put new carpet in or new curtains? Do I have to get a valuation then? No, you just put the cost in the chattels, in the depreciation, but in the balance sheet depreciation schedule. And just one final thing, because I didn't mention it, if it's under $1,000, you can claim it outright.
Nice. Okay, Connie's back in the chat. She goes, if I sell a property that I've owned for 2 years and didn't claim depreciation, does that mean I won't have any clawback and can keep the profit?
Correct. That's assuming you bought that property without the intention to flip it, trade it, or otherwise. But yes, long-term buy and holds after 2 years are non-taxable in any way at all.
Cool. Next one. If we change our family home with a mortgage to a rental, can we get interest deductibility without having to change the structure, e.g. a look-through company?
In some cases, you can get additional relief, but the reality is that to do it properly, you have to increase the cost base of the asset. And to give you a really good example, if you buy a property 4 years ago and it cost you $600,000, it's now worth $900,000. Forever, your cost base is $600,000 unless you move property into a new structure. We don't just go moving properties willy-nilly. We want to see some other commercial outcomes there, asset protection, ability to do something better with the profits. And the reason being is that we will need to also be able to stand up and have the correct narrative for having made the change.
But if you've got debt on a family home that becomes a rental, that debt's tax deductible.
Correct. If you just turn it into a rental. Yeah, definitely.
Cool. Okay, next one. What's the cost for a person having a company doing a home-based clothing business and an investment property outside the company? Oh. I mean, you just say book time, talk to somebody, right?
Yeah, can you book in? So there's no obligation. We do no obligation.
What kind of clothing? Like we're talking beanies,
jumpers?
The
high end.
Yeah.
Is it ready to wear or
anklets?
Yeah, ready to wear. Is it haute couture?
It depends. Yeah. It depends.
So it depends, but book in a chat. There's no obligation. We will have a chat about your business, ask you some questions. We'll send you a quote. That easy.
Cool. If we are to subdivide our owner-occupied property, is it better to get title using cash or borrow from the bank and pay the owner-occupied mortgage with the cash? When is it best to get tax advice for subdivision of an owner-occupied home?
Assuming you're going to subdivide to either keep as a rental and or sell.
Fair assumption.
Fair assumption. sooner the better. And the reason being is there can be some big tax traps when you do subdivisions, and there's ways to basically avoid tax in totality and or pay tons of tax if you get it wrong. So short answer is it would be better off to have the mortgage on the subdivided property, not on your own occupied, because that's where the tax deductibility lies. Sooner you get the advice, the better off you're going to be.
Nice. Next one and last one for now.
We better check the chat too.
Better check the chat for more text questions.
Yeah.
If I move to the US after hearing your amazing accents to study, and I hold my property as a sole income, which would be better to benefit from for taxes, rent the whole property or sell it in the next 3 months?
Well, you're not going to pay any. Well, assume you've held it for more than 2 years. You're not going to pay any tax if you sell it.
Planning advice.
Yeah. I mean, I'm a big believer in holding assets over the long term. Also think New Zealand's property market still has quite a bit of room to move over the next 10 years. I think New Zealand increasingly is seen as a country that is desirable for people from overseas with money. And, depending on what market you're in, if you're in the Auckland market, for example, I just look at the Auckland inner suburbs and imagine being in Sydney 10 or 15 years ago and having the opportunity to buy a property. It's pretty much what's going to happen here. So not financial advice. You're better off to hold it, but of course that depends on your goals, on your cash flows,
Situation.
what you're doing. Yeah. So book in for a call.
Cool. Next one is, if I do the repairs myself, how do I claim the physical hours that I've worked?
Yeah.
Or can I only claim for the materials? I'm a working man or woman and I want to be paid by myself.
Yeah. I get asked this commonly, and I get it. The answer is you can't claim anything. And that might sound dumb, but what's even dumber? You have a property, or say, imagine you've got a company with 2 investment properties, and you take a deduction for your own time. Your company gets to claim it, but then you have to put in your own tax return. So basically, it's just a money go round. So there's no winning. There's no winning there. Well, I tend to look at it better like this. I tend to look at it and go, is the value of my time spent doing this repair better used doing something else, like in your job, in your business, getting ahead? And that's how I make the decision, not on whether I can make a deduction.
Cool. Janet's asked, I have a studio and intend to let it out as short-term Airbnb. How much is your fixed price fee?
Is that, I think, assuming it's individually owned for an Airbnb, I think it's about $850 plus GST.
We will have
to quote, just for those going, you didn't quote my business one. Too hard to quote business. We do really simple fixed fees for property, easy to quote, but anyone wants a quote, just book them for a call.
Yeah, have to understand what's going on.
Yeah.
Next one, what is the best structure if you have your first rental and currently just paying personal tax and not claiming much, as I need to move my mortgage over to the rental?
Yeah, so this one's, it depends. Are you going to build a portfolio? Are you going to need flexibility later? Is it going to be positive yield, negative yield? Ideally, even with one investment property, would like to see at least as a minimum a look-through company, professionalism, separate legal entity, limited liability. Simple, but booking for a call because there's too many variables for that one.
Sweet. In a efficient way, Matt, can you explain what a LTC is?
An efficient way. You're asking big questions now. Look-through company is an LTC. That's it. It's a fiscally transparent company where profits and losses flow out to the individual taxpayers involved. I like to think of it as a closed company treated like a partnership.
Cool. I think we've answered that one already. I think we're
done.
We're good.
We're pretty much on time, and I think people stayed with us, which is pretty good.
It's amazing how many people listen to over an hour of text discussion.
Yeah.
Awesome. All right. Well, thank you everybody for joining us for tonight's webinar. Any tax questions at all, there's links all through this chat. Jump on our website, lighthousefinancial.co.nz. Check out the podcast for more helpful financial tips. Mr. Taxman, you're going to have a cold shower after that one.
Oh, man, I'm heating up.
And we'll catch you next time.
Thank you, guys.